Hi everyone, welcome back to the channel. With Valentine's Day right around the corner, love is in the air. But today I want to talk about a different type of relationship, and that's the relationship between love and money. Whether you're dating, engaged, or have been married for a long time, finances play a huge role in any partnership. Today I'll share some key strategies that'll help you and your partner build financial harmony and grow wealth together. The first strategy is whether to have joint or individual bank accounts. Now, there's no one size fits all. Everyone is different, but I'm going to give you three different options on what a lot of people do and what we recommend for a lot of our clients. The first one is to have completely separate bank accounts. This is where you have your own bank account, your income goes into those individual bank accounts, your expenses come out of there. The benefit of that is that you can keep things separate, especially if you have a partner that has different spending habits. The other option is to combine your bank accounts. So you have one joint bank account, both of your incomes go into there, both of your expenses come out of there. The benefit of that is having simplicity, transparency. You don't have to manage multiple accounts. But for a lot of people, having one joint bank account just doesn't work for them. The last option, which we recommend for a lot of people and actually ends up working for a lot of people, is to have more of a hybrid approach. Now, with the hybrid approach, essentially what happens is you have your own separate bank accounts, but then you have one joint account that you share the shared expenses. So things like your mortgage or rent, groceries, utilities, those things would come out of a shared account. And then the individual accounts is where your income, your paychecks would go into. This way you can decide together how much you're both willing to contribute to the household. You put that equal contribution or that contribution you decided on into the joint account, and then all your expenses come out of that joint account. And this seems to be more of like a happy medium for a lot of people. The next financial strategy is to have regular financial check-ins with your partner. Because talking about money shouldn't just happen when there's a problem. Just like having date nights that keep your relationship intact and to keep the spark going, having regular financial checkups ensures that you both are on the same page on major financial decisions. And here are some of the things to talk about during those financial meetings. You want to go over your income, your expenses, and your savings goals. And if you have a budget, you want to review your budget to make sure that you're not overspending in any one particular category, or if you have a particular category that you're not even going to be spending any money on. So you want to go over your budget line by line and just to make sure that you're on track. You also want to discuss any big expenditures that you have coming on the horizon. Maybe you have a big remodel coming up that you need to save for and to spend on, and you want to cut back on some of the other spending. Maybe you're thinking about buying your first home and you want to talk about the savings rate that you have. All these things should be captured in this regular check-in financial meeting. You also want to check in on your retirement and your investment progress. Maybe you've developed a retirement strategy with your advisor and you want to check in to see if you're on track, what additional savings you need to make, what additional accounts you need to put money in. All these things need to be discussed in a regular financial check-in meeting just to keep you on track to make sure that you're on the right path to whatever financial decisions you're trying to make together. The next financial strategy is managing different spending habits. It's very common for couples to have different spending habits. One partner may be a spender, the other partner is a saver, but it's really the exception where you have both partners that are good savers. And the idea is to come to some common ground and not to change one another, but to come to some common ground and have some tips and some guidelines on what you can do together to make sure that you're meeting your common goals. So here's some tips to help you come to some sort of a common ground. The one would be maybe deciding on a spending limit. So if one partner is a spender, maybe decide on a spending limit. So if expenditures go beyond a certain amount, then you have to both check in to make sure that you agree with that expenditure. Another option could be maybe having some fun money. So budgeting a certain amount every month where the person who's a spender can spend it on whatever they want and there's no guilt associated with that expenditure. Another tip could be prioritizing certain goals together. So for example, if you both agree that you want to save to buy a house, or you both agree that you want to save to pay for your child's college education, that could be a dual goal that you both agree upon and you prioritize that. But the important thing is you're not trying to change one another. You're just trying to see and create a system that works for both of you together. The next financial strategy is planning for your future and making sure that your overall goals are aligned with one another. And here are some things to kind of keep in mind. One thing is to make sure that your overall retirement goals or your overall goals financial are in line with one another. Maybe one person wants to retire early and another person wants to retire later. Maybe one of you wants to retire in Europe and the other person wants to retire in Asia. You want to come to some common ground on where you see yourself retiring or what you see yourself being those financial goals. So clearly being on the same page on those is really important. The other thing you want to look into and make sure that you're both aligned on is some sort of a risk tolerance. Again, it's very rare that you have two couples or two partners where they both have the same risk tolerance. One could be a risk seeker while the other person is averse to taking risk. But you want to come to some common ground together and some amount of risk that you're both willing to take together to help you meet your ultimate goals and your ultimate financial goals. Another important thing to have is make sure that your wills, your trust, and any type of estate planning documents are all in place and that they're in line with your ultimate objectives. So if you don't have a trust in place and you have a family, you have a home, and maybe this is your second or third marriage, you definitely want to have some sort of an estate plan in place to make sure that your assets upon your passing go to whoever you want and not have the state decide who those assets go to. Lastly, you want to make sure that your taxes are optimized, making sure that you're taking advantage of all the benefits available to you, whether if you own a home, deducting your mortgage interest, your property taxes, if you're doing charitable donations, making those deductions occur, but really going line by line with your CPA and making sure that you're maximizing all of your tax deductions that are available to you. A little bit of planning today with both of you together as a partnership will really pay you huge dividends later on and set the stage for you to become successful. The last strategy is getting expert advice, because managing your finances or your taxes could become either tricky or overwhelming. But the good news is that you don't have to do it alone. At ACAP, we specialize in working with individuals and businesses like you, and we're happy to schedule a free initial consultation to get to know you and to learn more about your goals. And finally, if you like this video, please remember to like, subscribe, and share our channel. That way we can continue to make more content like this and to reach a much broader audience.